It's a great pleasure to present this paper this morning at the EBA conference. And the paper is a joint work with David Newton, Steve Boss, and Steve Ogino from University of Zurich, Binru Zhao, who recently received a job offer at Bangor Business School. Well, we started the paper that from 2019. At that time, that we still enjoy the very low interest rate, and at the moment, I think that the paper probably is even more interesting given that the high inflation rate that we are facing, and also that the high interest rate risk. And in this paper, we focus on leverage loans, which are a type of syndicated loan that are lowly rated with double B plus or lower. So you can see that these type of loans that suffers a high risk, credit risk, and leverage risk. And in 2013, that Fed, OCC, and FDIC, they jointly issued the interagency guidance on leverage lending. So we call it the guidance or the clarification. And this guidance, it does not cover non-bank lenders, although that it provides that regulatory requirements for leverage lending for the bank. So that this changed the game. So banks are covered, non-banks are not covered. And in this case, that it moves the market share for non-banks, increase their market share for non-banks in the leverage loan lending market. And also that given the limited comprehension regulation that both ECB and Bank of England issued joint warning on the opaqueness of leverage loan sector and how they underestimate the leverage risk. Well, although the clarification that is effective at reducing that bank-originated leverage lending, however, this triggered a migration of leverage lending to non-bank lenders, and also that some studies that find the competition between the regulated banks and non-regulated banks becomes fiercer, and also that which triggered an increase in covenant-light lending structures, which reduce the lender protections. Previous literature that they find once that the syndicated loan that they are securitized, so which going to lead to that lower investor protection, and also that are associated with lower loan spread. And also that we find when that a syndicated loan without financial covenants, which provides the financial covenants provides lender rights to renegotiate their loan contracts. So this can significantly that reduce adverse selection and moral hazard. So in this paper that we want to focus on that whether that leverage risk is priced for the leverage loan market, that the pricing are underestimated, and we especially focus that whether that this pricing is underestimated after that the guidance, the clarification is implemented. And we also want to investigate what are the potential channels behind the underestimation of the borrower's leverage risk premium. So we hope that these results of this study could provide some policy indications. Our sample period covered from 2011 to 2019 before the pandemic, so that we have borrower information from CompuStart, and the syndicated loan information, they are extracted from Refinitiv, Icon, and LPC DealScan. And we link the borrower information and the syndicated loan information that from the link table constructed by Chava and Roberts 2008, and we extended the link table to 2019. And our final sample covers 5,450 leverage loan facilities, so which are in 3,500 leverage loan deals, and they are lent to 1,385 US non-financial firms. So we run a diff model, and the especially interesting that relationship is beta 1. So we focus on whether leverage risk is priced, significantly priced, and whether that there's an effect by non-bank or bank lenders, and whether that the clarification after the implementation of clarification that has an impact on leverage loan and leverage risk premium. So that the dependent variable is all-in spread drawn, so which covers the loan spread interest rate plus that the annual facility fees. And from this graph illustration, you can see that, okay, the red line are the all-in spread drawn for non-bank, and the blue line are the all-in spread drawn for banks. And after the implementation of clarification in 2014, you can see that the spread got narrowed between non-bank and bank. And for non-bank lenders, seems that all-in spread drawn spread that significantly dropped. And we also found that after the implementation of the clarification, that seems that there is a significant and negative impact on bank all-in spread drawn. From the regression analysis, we also identified a significant and negative impact for leverage risk and for non-bank lenders and after the clarification, which indicate that leverage risk is underpriced after the implementation of the clarification in 2014. And this underpricing is especially significant for non-bank. So we can choose for year fixed effect, industry fixed effect, and loan purpose fixed effect. And we can see that since the impact is slightly stronger for term loans compared with revolvers. Well, to mitigate the concerns that our results is driving that by some unidentified determinants between bank and non-bank groups, so we also run a robustness check with PSM matching. And we can see that the results confirms that the leverage risk is underestimated that post clarification, and this effect is especially stronger for non-bank lenders. So to further identify that what mechanism works behind this underestimation of leverage risk in loan pricing after clarification, we first look at that the CLO issuance, the securitization, and the covenant protection for the loans. So we find that a CLO issuance, that securitization of the loans, are highly associated with covenant-light loans, which means that these loans without covenant protection. And we also find that seems like that covenant-light loans for non-bank issuers that significantly increased after 2014. Further, that we run some subsample analysis so that we find that in the subsample of high leverage borrowers, the effect is more significant and stronger, which means that leverage loan is less priced in loan pricing, that this effect is even stronger for the highly leveraged borrowers. And in the other subsample with low leverage borrowers, so we find that the effect is insignificant. So which means that the higher the leverage risk, that the lower the underpricing is. And we further test that whether this effect works in the subsample with performance pricing or without performance pricing. So for the loans with performance pricing, which means that the loan pricing is linked with the borrower's performance, for example, that the leverage risk and the profitability. We find that for the group that without performance pricing, the effect is significant and negative. However, that for the subsample with performance pricing, which means that this is with better lender protection, and in this case, the effect becomes insignificant. Sample with highly leveraged borrowers and lowly leveraged borrowers, we find out that seems for highly leveraged borrowers that this effect is very significant and negative, especially that this when we link this with CLO issuance, which means that when a loan that is securitized and that is moved out of the bank's balance sheet, seems that in this case that the leverage risk is significantly underpriced. So that overall, we find that leverage risk is underpriced after the implementation of clarification. And this underprice is significantly driven by covenant-light loan and also driven by that issuance of CLO. So both of them that are highly associated with adverse selection and moral hazard issues. And also that we find this the paper provides important policy indication on how to regulate the leverage lending market and how to increase the safety and soundness of financial stability. So thanks a lot for listening to the presentation, and I'm very looking forward to receive some feedbacks and questions about the paper.
So thank you very much, Ru, for the very timely presentation. So the discussant of the paper is Simone Casellina from the EBA.
Sharing, or I don't know if I can do it from here. I don't know if, yeah, I don't know if she should stop sharing from her side now. Is it already opened? No. Okay. So we did it. So thank you. I'm Simone Casellina. I work here at EBA, and in particular, I work at the impact assessment unit, and I have a statistical background. And well, let me start saying that I really like to read this paper because usually in impact assessment, in banking regulation, we don't have the opportunity to work on a control sample, because usually when regulation enters into force, it enters into force in the same moment for all the subjects. But in your work, you were able to build a control sample because you worked on the introduction of a new regulation, this guidance on leverage loans that apply only to banks, but you had data also for non-banks. And so you had the opportunity to analyze the different behaviors of these two samples. And for example, these are in your paper. this evidence. I think that this evidence should be really took in consideration by regulators. In particular, I was surprised because it tells, in particular, it shows in particular how quick can be the market to react. Here, sorry, I was saying. Oh, sorry. Next bit. I was saying what implicitly said these two charts is that the market could react very quickly. You see that from the introduction of this guidance, something happened. It is the vertical red line. You see that exactly after the introduction of these lines, something happened. So this should warn regulators that when we try to go against the markets, it is possible that the markets find their way to bypass the regulation. Then you use this very interesting database with granular data at borrower level and where you were able to distinguish the originator in banks and non-banks. And I was really pleased, for example, to see that you were able to use this technique, propensity score matching, something that I studied, but then rarely I've seen applied to banking regulation. Here I have a small question. I see that you wrote that most of the explanatory variables are significant, but I don't see the accuracy, the accuracy ratio area under the curve. I know that there are some doubts about the use of this kind of indicator, but I use it to consider it. But overall, I think that your paper provides sound, strong evidence about the presence of some opportunistic behavior from some market participant. So let's go to my question. The first one is when I read the title the first time, I thought that the paper was about loan pricing, so understanding if the price is adequate, but this is not what your paper is about. By focusing on the spread, you are able to provide evidence about this opportunistic behavior, but you don't talk about the adequacy of the interest rate. For adequacy, I mean the adequacy in comparison of the cost of funds, operating cost, and then what we are used to consider, to call expected and unexpected loss. So my first question is, will it be possible with your data to do this kind of analysis, that is to evaluate the adequacy of the spread of the interest rate, given the risk, for example, for risk I mean defaults rates and loss rates. So is this information available in your data? Then I noticed that this amazing data set is about United States. I didn't understand if this database is proprietary or is public, but in any case, this raises me the question, do we have data about shadow banking? Well, I tell you, I'm not an expert on shadow banking, but working here, I've heard talking about this many times, but I think that we don't have, at least here at EBA, data about shadow banking. The only thing that I was able to find is this reporting requirement where we ask banks to report their 10 largest exposure that they consider unregulated financial entities. And with this data, for example, I was able to see that the exposure of regulated European banks toward the shadow entities not so high. It is just 1% of the total asset. So my question is, do you know if we have data at the European level about shadow banking, and in particular if we have data about the relationship between the regulated sector and unregulated sector, because this is what should worry us, the possibility of a contagion effect. From this simple statistic that I did, it is clear that it seems that there are no connection. And lastly, I try to understand if we have a definition of shadow banking. For example, I found this study, this recent study promoted by the Commission, this long study. And I was impressed by the fact that in this study they spend a lot of pages analyzing different definition of different possible definition of shadow banking. And this is a chart from their study where they map different approach to define shadow banking. And at the end, I try to understand, but do we have an at the end, an operational shared-on definition of shadow banking. For operational definition, I mean something that could allow observable individual to take observable decision. And for example, in your paper, you start from this generic definition of shadow banking. We probably could agree on this. And then you decline it saying that non-banks are insurance company, corporation, finance company that originate loans. But then I found this recent regulatory standard issued by the EBA here, where they start from a different general definition. In practice, it is said that institutions that are under some regulation that can be considered aligned with the banking regulation should not considered shadow banking entities. And then they do some list. For example, they say that insurance companies in Europe, at least, are under a regulation that is similar to the banking regulation. So it means that we should exclude insurance company. And then they go on with their list, and you see what happened. It seems that these two general propositions do not agree much. So I still have this question: do we have a clear definition of shadow banking? So I came back to the data that we have, and I tried to do this small experiment. I took borrowers that are classified as shadow entities by at least one bank, and that are reported by more banks, and I try to see if these banks agree on this definition. So you see, for example, here in the last case, this is just an example. We have 5 banks reporting this ID, and they all agree that this borrower is a shadow entity. And then I took the average of this indicator, and you see, if we add clear defined rule to define shadow banking, this indicator should be near to 100%, and instead it is below 50%. So it seems that we still don't have a common definition of shadow banking. So these are at the end my question. Should it be possible, interesting to develop a pricing model to see if the interest rate applied by these entities appropriate given the actual risk? Do we have data about, in particular, the relationship between the regulated sector and the unregulated sector? And then maybe the most important question is, are we sure we know what shadow banking means? And that's all. 9 minutes.
Thank you.
Thank you, Simone, for that. So I would now open the floor for questions. So for you who are participating virtually, there's a possibility to type in questions in the WebEx chat. I will then read them out loud from here. Maybe in waiting for some first questions, maybe Ru, if you would like to already reply to Simone here first, and then we go for the Q&A session from the public. Please.
Thank you so much for the discussion. Well, I think that you have mentioned some very helpful points. So the first one is that our dependent variable is the loan price or in spread drawn, that whether this could cover risk. I think this is a very interesting point. So what we have found out is that these loan price, these risk premium are not significant enough to cover the risk, but we didn't investigate that or quantify exactly how much risk these borrowers bring into the market. So I think, yes, that's true. In this paper, we didn't quantify so the borrower's risk, how much risk, and how they increase or decrease their risk. So these points we didn't cover in the paper. What we want to cover is that whether this risk premium is big enough or is enough to cover the risk of the borrowers. And also the second point, I think you focus on shadow banking. which is another very interesting, important point. So I think that you have the expertise in this area, how they regulate it, and what are the difference of their reporting. Yes, that's also that some gap that we didn't cover in the paper. We identify that they are bank or non-bank. And also you mentioned that this database from ICON and DealScan. So the loan data in this paper are from both ICON and DealScan, so we double check. However, that these two databases from the same data provider, PSA, so there should be the same information, but to double check and to make sure that the information are in line with each other. So we extracted data from both of them, and also that we make sure that the data from these two are in line with each other. And this database, they only cover that syndicated loan in both DealScan and ICON. They don't cover all the commercial loans that are not syndicated. And also that we don't have specific information about shadow banking in this paper. So what we want to do is that we want to say that if regulators regulated the banks and the other financial institutions, they are not regulated by the guidance or the clarification. So whether these could generate some impact to the market, whether this could change the rule of the game. So before that, none of them are regulated before the implementation of the clarification. There's no specific regulation for leverage lending, either for bank or non-bank. However, afterwards, banks are regulated. So we find that seems that the market portion for banks in leverage lending market dropped significantly. And who gains the market share are those non-regulated financial institutions. So what do we mean non-regulated financial institutions here is, as you mentioned, we mean that insurance companies, mutual funds, pension funds. But I think if we could have a deeper look of shadow banking and their reporting to the regulators would make the story even more interesting. I think both of the points are very important, and I think maybe that we could have some further look and make the story even more interesting. Thank you so much.
Thanks.
I also received the chat and I will send the paper. Thank you.
Yeah.